subscribe now and press the bell icon. Never miss an update.
We'll quickly start with that. If you remember, chapter 5 was all about, below the line deduction, right? Because once we derived AGI, then we are looking into what further expenses can be deducted. And so now all these expenses that we are going over, they're all part of itemized deductions. We talked about what is standard, what is itemized. Standard is something given directly by IRS, no questions asked, just go ahead and take that and reduce your income by so and so amount. But if we think our itemized deductions are going to be higher, then we don't want to settle with standard. We'll probably go with itemized deduction so we can get the best possible tax benefit. So I think last time we saw taxes, state taxes, if you remember, and there is a $10,000 limit on that. Does anyone of you remember that?
Yes, ma'am.
Good. So yeah, there was a $10,000 limit. So now, it has completely changed the situation from what it was 2018 and prior. People used to, take $70,000, $80,000 as just as itemized deduction. So imagine if their income was around $300,000 or $250,000, straight away 50,000 will get reduced. So the taxable income will come to 200,000. That's a big deduction. It used to really help people in high tax states, which is like California or New York and all, because there the tax rate is very high, like almost 8 to 9%, as compared to say maybe Arizona, where it's only 4%, or Texas, which is 0%, or some other state which could be like maybe 2%, 3%, 4%, whatever. But California, New York, and all, they're amongst the highest taxed, and it really hurt the people over there. So anyways, we cannot do anything. 10,000 is the limit, and there are a few other deductions also that can be claimed. So we'll just go over that. But one thing which has happened is now the percentage of California or New York residents, those who used to go for itemized deductions, have really reduced a lot, because now it doesn't make any sense. Only 10,000, they're paying like maybe $40,000, $50,000 in state taxes, but they get benefit of only 10,000 as a deduction. It's really not helping them. So we see more and more people going for standard deduction now, and that's a way of maybe taxing high earners, high income people, by reducing their deductions. People those who are living other general public, those who are living in states Midwest like Kansas or Missouri, or somewhere like even small states like Maine or Minnesota and all those places, it really doesn't matter, because the income levels were already very below as compared to the standard levels of California and New York. So they really didn't get hurt much. But most of our clients got hurt because the $10,000 cap came in. Okay, but it is what it is. Hopefully, after 2025, they're going to remove it, and people will be able to take the deductions again. So now we look into interest expense. What all kind of interest expense can be deducted? The biggest one is obviously mortgage interest. People don't pay as much as on their car interest, like if they took financing for the car or for some other personal assets or something else. I mean, that's something very minimal amount that they pay as compared to their home loan. Home is probably the most expensive thing that they must have bought in. So that's where they pay the highest amount of interest. So if there is a mortgage interest, if there is a mortgage loan on home, and if the person is paying the interest, we should definitely find out, because that may be a reason why the person should go for itemized deduction and not stay with standard. So we'll go over some of these examples, but personal interests are not deductible. And what does that include? Any trade or business debt, that will not come under itemized. That will probably go into Schedule C and all. Investment interest, that will go against investment income. It will not come under itemized, under Schedule A. Passive activity interest, that could offset some passive activity income. Certain other student loan interest, yes, there is a limit, $2,500 and all, but that will all go under a separate category. It is not included as part of interest expense on Schedule A. So let's not get confused that these are not deductible. These are deductible, but they'll probably go and get deducted in some other places, but not on Schedule A. Right now, we are just focused on Schedule A. Qualified residence, what does that mean? That this is a residence interest, but IRS is still not allowing because the loan that you have taken is way too high. Again, all these benefits are given to people, those who have average income or lower income. And I think there is a limit here. Yeah. So if you have taken a loan for more than $750,000 towards the home, like so acquisition loan or home equity, more than 750,000 for married filing jointly. If you have taken this much, then your interest is limited only to first $750,000 of loan. Maybe you've taken loan of, maybe the person has taken a loan of 1 million or 1.5 million and all. So the interest will not be deductible on any amount, any loan amount beyond 750. And that's something we have seen our clients getting notices also. Maybe because either we did not pay attention or they didn't give us proper loan amount and all. So we took the entire amount as interest, and IRS got back and said that, okay, this is not deductible. And what is a qualified residence? It has to be a residence. It doesn't have to be a rental property. Again, there is a that the residence test of 14 days or 10% of the number of days it was rented and all. We have gone through this test. Okay. Any another thing is that this people take home equity loan. What is home equity loan? That, see, one thing is that when we buy the home, we go ahead and get financing done. Okay, when we're buying something for $1 million, we'll probably put like 20, say like 15% or 10% from our pocket. Say $100,000 has been put up as a down payment. For rest of $900,000, maybe the taxpayer is going to some financing company or a bank and get it financed. That is called the acquisition loan or simple loan. But now you got it financed for 900,000. Okay, we have bought it for 1 million. Now pay attention to this. Say after 2, 3, 4 years, the value of the house increased from 1 million to 1.5 million. The loan is still 900,000, but now the value of the house is 1.5 million. So the lender is in a very comfortable position. Okay, the value is not going down. So even if they've lent the money, they're kind of, okay, the worst case, if this taxpayer does not pay interest on time, we can take away the asset, and the asset is going to get sold for much higher price. So what happens now? There are companies, right? These financing companies, they just want to go ahead and keep giving finances. So they'll go to the taxpayer and say, "Hey, you know what? Your house loan has increased by half a million. Sorry, your house value has increased by $500,000. So that's really great for you. Okay, that means we are also increasing your loan limit. So earlier we gave you a loan of 900,000, but if you really want, we can give you another 200,000, another 300,000." Because we don't see a risk there. The value is pretty high. And that is called home equity line of credit. Equity is something which is built up, it's a value that increased. So that's called equity line of credit. You can take it anytime. People take equity line of credit, they may use that $200,000 extra loan to pay off some their other liabilities, or to maybe buy a car, or pay education expenses, or pay some other medical needs, or whatever. They can use it for n purpose, n number of purpose. Okay, there is no such, like, financing company doesn't say that you have to use it only for I mean, they don't come and check. So usually equity line of credit, you can even, if you want, you can also put that money in your business. But IRS will not give the deduction. What IRS says, if you're taking home equity line of credit, you want to claim mortgage interest, make sure you're using that money only for the purpose of home. Either probably you want to remodel the home, you want to get some repairs done, you want to get an extra room built up, or you want to change the entire roof or all appliances, whatever. You need to use that money only for the purpose of home. And if you do that, we'll let you deduct more interest, provided that 750,000 limit is not crossed. So in my example, that limit is crossed. So, I mean, but you just don't pay attention to that right now. The whole point of saying that is that the money should be used to buy, build, or substantially improve the residence. So if you're using the funds for other personal expenses, it is not allowed. Okay, we'll go over some examples that will make it clear. And okay, let's just go over quickly other things. Investment interest, that is not allowed as a deduction here. But we can definitely claim it against investment income. Investment interest may be deducted to the extent of net investment income. Okay. Then what is investment income? We know all about this. It could be interest, dividend, rent. Some people may just may lend money, like they may borrow money from few lenders, and they may just speculate in the stock market, saying that, oh yeah, if I get 100,000, I'll probably turn it into 200,000. But I don't have that 100,000 to start with. Let me go ahead and get some loan. People do that. People do all kind of crazy stuff. So and they're probably paying tax also on it. Not tax, sorry, interest also on it. As long as they're having some returns out of it, they can deduct it. Otherwise, it's not allowed. Same thing with any passive activity and all, like, if like mortgage interest on a rental property, that is deductible on Schedule E as rental expenses, not on Schedule A. Okay. So, okay, yeah, let's just go over these two small points. Points paid now. Okay, I mean, this is something very, very new for most of us here, because we don't have this system of points and all in India. What does that mean? Is like a lot of times when the client comes to us and says that, I have bought this property and I'm also paying points on that. We need to understand that there is a different way things work in US. Points paid meaning they are paying some extra money, okay, to maybe limit their interest expense, or maybe if it's a general practice. But it's just that the buyer is paying some extra money to the seller or to the financing company, and those are more like prepaid interest and all. So they are paying it in advance, and that will give them some security that, okay, we will make sure your interest is not crossing certain level, because the interest may need to be reset every year or every 3 years, every 5 years. You cannot, if one person is paying 5%, doesn't mean that, right, they will continue to pay 5% forever. Usually it gets reset. But by paying some extra money, and they call it points. So I'll say that, okay, I'm ready to pay, say, $5,000 extra for the points, but make sure my rates is not going above 5% for another 2 years, or put some kind of, like, give some cushion on there. Okay, so that's what is called points. So those points are always deductible. So and those points are not paid on annual basis and all. It's only when the property is purchased, that's when all these things are done. Okay, we'll go that soon. Then there's something called mortgage insurance premium. Again, if the buyer is not able to pay premium in time, there is an insurance company that will make sure that in case of default, the insurance company pays to the lender. So it's like getting an insurance on the liability. And that's also very common. So those mortgage insurance premiums are also deductible. Okay, they're usually deductible as interest expense, and they're deductible for 2023 as well, or 2022. But the deduction phases out if the income is increased, has crossed certain level and all. So it may not be given to everybody, but there is a line item for qualified mortgage insurance premium and all, and we can look into it furthermore. But for now, what we need to remember is if there is an insurance scheme taken to cover up the risk of paying premiums, in time, then those are also deductible. So a lot of times the taxpayer will go to some another insurance company saying that, okay, I'm going to pay this every month just in case I lose my job or something happens. And if I don't have money, please give me some kind of insurance that, you're going to cover up for that, or make sure that the payments are going out to the seller and all. So they might be paying some extra money for that, and that's also deductible. Okay, mortgage insurance premium is not that common, but and then plus the limit is very very low, so that's why again we don't see, people only earning less than $100,000 will get these deductions. Okay, so let's go over any questions. We can just take a break for a couple minutes, and then we'll go over some of the examples. He's paid 3,000 on his credit card bills, 1,200 car loan, and other stuff and all. Like these are all personal interests. They are not deductible on Schedule A. Only interest related to your personal or primary residence can be deducted. Okay, so that's definitely not deducted. Now next, personal interest from medical expenses. Divyansh, you want to read this?
Carl Ryan paid $8,000 in the medical expenses related to his 5-year-old son. Broken leg. In the order to pay these expenses, Carl looked to a loan which is incurred interest for $500. Carl may deduct medical expense in the excess of 7.5% of his HEI. However, he may not deduct the $500 for interest because considered personal interest.
Right. Again, this might be a genuine need. It's not like he's going away and like throwing off the money on vacation or other luxury items. This is genuinely needed, but still, that's not allowed under this category. It is still considered as a personal interest. So for all the expenses, whatever $8,000, he can deduct these if they are more than 7.5% of AGI, and that's something we have seen. I think, we have already gone through that in the last class. So again, those are, I mean, what they're saying is through this example that these are all personal interests. Let's not get confused. Let's not deduct those interests. Only something related to home mortgage will be deducted. Okay, Vandana.
Kyla borrowed money to invest in year 3 due to a bad market downturn. Her net investment income was $4,500 before considering $15,000 of investment interest expense. In year third, she may deduct $4,500 of investment interest expense, and the remaining and the remaining $10,500 is carried forward over to year 4 to be applied against net investment income.
Right. So what we saw here, investment interest may be deducted only to the extent of net investment income. You cannot go negative on that. Whatever is extra which is being incurred can be carried forward. And I think it can be carried forward indefinitely. Yeah, disallowed investment interest is carried forward indefinitely. Okay, so that's what they're doing. The investment income, her income is only 4,500. Maybe a bad market downturn. Okay, maybe like she was expecting much more, but the market went bad and her income is only 4,500, but the interest expense was fixed. So she ended up paying $15,000. So she cannot deduct all of 15. Only 4,500 will be deducted against this income. It will make it as zero, and rest of 10,500 is carried over to the following years. And again, these are the things we are not going to do manually. If we just have to put in the interest expense number in the right category, that this is the investment interest expense. The software automatically goes and finds out what is the investment income, and it will all take only what is allowed, and rest it will carry forward it, and it again automatically gets carried forward. So when we use the file from prior year and we roll it forward to the next year, all that information gets uploaded into the next years. We are not doing any of those things manually, but we need to still pay attention. We still need to keep our eyes open and see what is happening here, so we can thoroughly understand. And if client has any question, we can also answer it with full confidence that if we know the rules. If we don't know the rules, we'll just get lost. We'll say, oh, we don't know, something happened and the software is not doing this, so we don't know what's wrong with the software. So at least if we know the rules, we know that, okay, only this much is deductible. So obviously software is going to cut it off here, but the rest should be carried forward. So where is the carry forward worksheet? Maybe it's somewhere there. Let's go through the form properly, look into all the tabs. And one of those tabs, you'll probably see that, okay, disallowed investment interest carry forward to future years. And then we will see some number over there. So at least we'll make sure that this is what is happening. We are not doing a lot of those things, we are not doing manually, but we still need to understand what is happening behind the scene. Okay, next, 5.11. Who wants? Garima, you want to read this?
Okay, ma'am. After 3 years of home ownership, a taxpayer's home has increased in value by $150,000. In 2019, the taxpayer took out a $100,000 home equity loan to pay for her children's college education. However, interest on a home equity loan that is not used to buy, build, or substantially improve a qualified residence is not deductible.
Right. Can you explain this?
Yes, ma'am. Ma'am, as we have already seen that home equity loan, it is not deductible. Oh, 1 second. Yeah, how much it is taken? The taxpayer took 100,000 home equity loan to pay for her children's education. This is not used to buy. Exactly. Since it is not for a qualified residence, so therefore this 100,000 is not deductible. Is that so?
So it's what we need to focus on is how that loan has been used.
Right.
The residence is qualified residence, or like, I mean, it's clearly this is a primary residence. Okay, so it's not about qualified or non-qualified residents. So obviously non-qualified, then we are not even talking about this thing. So there is a proper primary residence. The taxpayer is allowed a deduction on that primary residence. But what we need to pay attention here is the loan is not used for home. So IRS, the whole point of IRS giving this deduction is that you use that money related for your home. Do some expenses in your home, or just like do whatever, it has to be used for the home. Because this is home equity line of credit. It is not a simple credit card line of credit. Like, okay, credit card also we get a limit of $10,000, $20,000. So people go take out credit card loans also. That's something that can be used for anything. If you're taking home equity line of credit and you want it to be considered as a deductible, you better spend that money on the home itself. Now here, the taxpayer is not able to prove that he used the money, he or she, to buy, build, or improve the residence. Okay, that money went into college education. So that's fine. You can use the money, and I mean that's an arrangement between taxpayer and the bank who is funding that. If the bank puts some restriction, that's different. But if the bank says just take the money, you use it, whatever, we don't care, then taxpayer can use it anywhere. But IRS is clear on that we will not allow you deduction. Okay. Okay, then Siddhabi 5.12.
A taxpayer with AGA of $1 lakh made the following transaction in year one.
Siddhabi, let's call this as $100,000. Okay. We need to get into that habit.
$100,000 made the following the transaction year one. Paid $3,000 interest on a bank loan. Using the loan purchased interest bearing the bonds with interest income of $10,000 in year one. No other investment income was earned in year one. Paid personal credit card interest of $650. Paid interest in the amount of $12,000 on home mortgage of for year one. The dollar 15,000 total interest expenses in calculating itemized reduction for year one is calculated as follows. Net investment income is
So
$10,000.
let's look here. They're clearly saying that interest bearing bonds, so there is an interest income of 10,000. Okay. And he or she has taken a bank loan for $3,000. That is a, maybe use that, took that bank loan and put the money in the bonds and interest on the interest of $10,000. So deductible investment expense is 3,000. Because 3,000 is lower than the interest income, we can take all of that. Okay. Clear, Siddhabi?
Yes, ma'am.
You able to follow? Yeah.
Yeah,
Okay, next. Home mortgage interest is how much?
$12,000.
So total of that is allowed.
15,000.
Correct. 15,000 is allowed, but that doesn't mean all of 15,000 will go and sit under mortgage interest line item. 3,000 will go at a different place. Home mortgage interest is Schedule A will put 12,000. Like on the proper section that I'm talking about.
Okay.
And personal credit card interest is obviously not deductible at all. Okay. So credit card interest is a personal interest expense, and that's why it is not deductible. If it was the other way around, that 3,000 is the income, 10,000 is the expense. Okay, once again, if 3,000 was the investment income, $10,000 was the expense, how much of that $10,000 would be deductible?
3,000.
Right. And the rest would be carried forward to the following years. Okay. So clear? These all interests can be taken up as a deduction. Okay, let's look into these points thing. We have already looked into it. Like we've just touched on that, but we'll go over some important things here. So points paid by the borrower with respect to home mortgage are prepaid interest, which is typically deductible over the term of the loan. And the escrow statement, we always call it as settlement, closing, or maybe escrow statement is very, very common word. When a client comes to us and says that I've bought this property, I've sold this property, the first thing we usually ask them is, can you provide us with the escrow statement? Because that escrow statement will list down everything clearly, like what is the buying price or selling price, how much loan has been taken, how much points are paid, or what other fees are paid. Maybe there are some notary charges, there is some title fees, there are some legal charges, there's some other taxes that got paid out as part of the deal. Maybe the deal is that seller is saying that, okay, I'll sell you this thing, but make sure for this year you are paying the full mortgage interest. I'm not going to pay that. So all those terms are, it's only one page document, but all the major terms are captured there. And that's very important document. Because from there, if there is any audit from IRS, what they'll also ask for escrow statement, like what are you deducting, what you're not deducting, and all just provide us with escrow statement.
Excuse me, ma'am. Does this mean it is a sort of sanction letter?
It's not a sanction letter. It's sanction letter is something different. Sanction is like what is the limit? I mean, what is the loan that you are eligible for?
But ma'am, again in sanction letter, each and every detail is mentioned.
Possible, but they're in US when you call they call them as two different things. Escrow is done when the deal is closed.
Okay.
Sanction may not be like sanction is something saying that okay, you are eligible for this. We're gonna give you so much of loan and so much of these things and all that. So when
Okay.
we're talking from US perspective, whenever you call it escrow statement, that means it's closed, it's done deal. Just
Okay.
take that thing, whatever is final, it's mentioned there.
Got
Now,
it.
there's something called approval letter or approval statement. That's where, before one buys the home, they go to the financing company and they say that this is my total income, these are my assets, this is the money that I have in bank. Based on all this information, please provide me what kind of loan can I get. And that's called approval letter or something, that you're approved, your limit is so and so, you're approved for so and so loan. So that may be a very general thing that, okay, based on your income, we can assign you a limit of 500,000, 300,000, whatever. That they will not list out all the details. But escrow will have each and every, even if $25 are paid for certain thing, like say legal charges or some kind of tax or notary document, notarizing any document, even that amount will be listed in escrow. Okay, so that's a full debit and credit of what is the liability that you're taking, what are the assets that you're getting against it, and what is being paid by the seller, what is being paid by the buyer, what is being paid by the lender on whose behalf. Okay, so because and then based on that escrow statement, we should be able to see what is that mortgage interest that one can take as a deduction, or any points. They will clearly mention points paid so and so. There will be a dollar amount to it. And generally, those are all we can take. All of these as selling expenses, like paid by the seller. And if the buyer is buying something, for buyer it's more of a prepaid interest, which is deductible over the term of the loan. Or if it's not an interest, if it's something else, you can also add it to the basis of the property. So again, that all depends on what is listed in escrow and all, but generally points are deductible. That's what we need to remember. Clear? Okay. So okay, then mortgage insurance premium also we went through. And those are also deductible. Again, they're also mentioned on Form 1098. And how do we come to know what is the mortgage interest paid out by the taxpayer? What form will tell us that? Shweta, you should be knowing that.
1098.
1098. 1098 will also give us what is the loan amount. So if there is a box that gives us what is the outstanding principal amount, if we see that outstanding principal amount is more than $750,000, at least it should raise some, it should ring some bells, saying that okay, maybe then if the entire mortgage interest is, say, for amounts more than 750,000, then we need to make sure we are deducting the lesser mortgage interest, not what is mentioned there. So it's always mentioned there. Then we can ask the client, or we can do our prorated calculations and all, and see we are taking a lesser amount as deduction. And I'm telling you, we have not paid attention to these things in the past, like couple of times, and we got a notice from IRS saying that this interest is not deductible. But the amount is mentioned on 1098. If we read 1098 carefully, we can easily know what is the outstanding loan amount.
So
And
the
we can,
software doesn't calculate on its own.
The limit
No,
of.
because software is not asking for what is the principal outstanding amount.
Mhm.
When we are putting, I think, things into the software, we are just putting the mortgage interest amount.
Okay.
Yeah, it should be. That's a good point. It should have that ability to do that. Maybe we can see if the newer versions do it and all. But typically, like it was not doing it earlier. But they should definitely put it because it's a straightaway calculation. If they can put in a box for what is the outstanding amount, then it should run that calculation. Federal state tax on income in respect of a decedent. Again, those are not very, very common. But if you go through line 16 of Schedule A, you double click on that, it will give you a lot of other categories saying that, okay, casualty and theft losses are also deductible from income producing property, any premium on taxable bonds and all, gambling losses. This is common. We have used this thing. We have some of our clients, those were gamblers. So we always use this line item that only up to the extent of gambling winnings, you can use those losses. And those are not carry forward. Huh? Those are not, like, we cannot take those losses. I don't think I'll double check on that, but I don't think gambling losses are allowed to be carried forward. There's certain other categories we can go over that later on. But any impairment related work expense, person with disabilities, if any of our client is disabled, we know if they're blind or they're permanently or typically disabled and all, then there are some other expenses that they can take a deduction for. Okay, then we'll focus on personal casualty losses. This is again a small point, but charitable contribution is we'll go over that because there could be a contribution in cash, in kind, in the form of a services, or in by giving certain used items. All of those things can be captured against charitable contribution. People donate their cars. People donate their used clothes also. So yeah, they can take a deduction for that. But how much, what is the limit, what is fair market value, and all those things we need to go over and see what is a reasonable amount to take deduction for. Okay, so we'll do that later. If no other questions, then we'll just quickly stop here.